Ever found yourself pondering over the idea of making money by investing in banks? It's a thought that has crossed many minds, and for good reason. Banks, after all, are the lifeblood of our economy. They facilitate financial transactions, lend money, and provide a safe haven for our savings. Investing in banks can be a rewarding venture. Banks generate profits from the interest they charge on loans, fees for services, and a plethora of other financial activities. As an investor, you can benefit from these profits through dividends and potential capital appreciation. But what makes bank investments particularly appealing is their resilience. Banks have been around for centuries and have weathered numerous economic storms. This resilience often translates into stable returns for investors. Of course, like all investments, bank investments come with their own set of risks, but with due diligence and a well-thought-out strategy, the rewards can be substantial. If this sounds intriguing, stay tuned as we delve into the step-by-step process of investing in banks. First things first, we must understand what bank stocks are and how they function. Just like any other stock, bank stocks represent a share of ownership in a bank. When you buy a bank stock, you're essentially buying a piece of the bank. But how does this translate into profits for you, the investor? Well, banks make money in several ways. The most common is through interest on loans. When a bank lends out money, it charges interest on that loan. This interest becomes revenue for the bank. Banks also earn from service charges, fees, and investments. For instance, let's say a bank lends out $1 million at an interest rate of 5%. This means the bank stands to earn $50,000 in interest alone. Now, this is a simplified example and doesn't account for things like defaults or operational costs. However, it gives us a basic idea of how banks generate income. When a bank is profitable, its shareholders, that is, the people who own the bank's stocks, stand to benefit. This benefit typically comes in two forms: dividends and capital appreciation. Dividends are a portion of the bank's profits that are distributed to shareholders. Capital appreciation, on the other hand, is when the price of the stock increases over time. But here's the catch. Just like any other investment, bank stocks come with risks. The financial health of a bank is crucial. A financially healthy bank is more likely to be profitable and therefore more likely to provide returns to its shareholders. That's why, before investing in bank stocks, it's vital to understand the bank's financial health. You can do this by looking at the bank's financial statements, understanding its business model, and considering the overall economic environment. Now that we've established a basic understanding of bank stocks, we're ready to explore the actual process of investing. In the next scene, we'll delve into the specifics of how to invest in banks, including what to look for in a bank stock and how to buy and sell these stocks. So stay tuned. Investing in banks might seem daunting, but with the right guidance, you'll find it's a process anyone can navigate. So let's break it down. First and foremost, you must conduct thorough research. Look for banks with strong financial health, a consistent history of profitability, and a promising growth outlook. This can be done by reviewing financial statements, analyst reports, and industry news. Remember, knowledge is power, and the more you know about the bank, the better your investment decision will be. Next, open a brokerage account. This is an account you'll use to buy and sell stocks. There are many online brokerages to choose from, so look for one that fits your needs. Some factors to consider are commission fees, customer service, and the platform's user interface. Once your account is ready, it's time to buy shares. Decide how many shares you want to purchase based on your budget and risk tolerance. Then place an order through your brokerage. You can set a market order to buy at the current price or a limit order to buy when the price reaches a certain level. After you've made your purchase, don't just sit back and forget about it. Investing is not a set-it-and-forget-it game. Monitor your investments regularly. Keep an eye on the bank's performance and the broader economic and industry trends. And remember, don't panic when the market fluctuates. Investing in stocks, including bank stocks, is a long-term game. It's normal for prices to go up and down. The key is to stay patient and stick to your strategy. Also, don't be afraid to ask for help. Whether it's from a financial advisor, an investment group, or an online community, there are many resources available to aid you on your investment journey. Finally, always keep learning. The world of investing is constantly evolving, and staying informed is crucial to success. Congratulations, you've successfully navigated the process of investing in banks. But the journey doesn't end here. Like any investment, bank stocks come with their own set of risks and rewards. Let's dive into the deep end and start with the risks. The banking industry is heavily regulated, and changes in these regulations can significantly impact a bank's profitability. For instance, a new rule requiring banks to maintain higher capital reserves could limit the amount they can lend out, potentially reducing their income. Another risk is economic conditions. Banks are sensitive to interest rates and economic cycles. When interest rates are low, banks earn less on the loans they make. Similarly, during an economic downturn, more people and businesses may default on their loans, leading to losses for the bank. Now, onto credit risk. Banks lend money, and there's always the risk that borrowers will not pay back. This risk is higher in periods of economic uncertainty, and it's something investors need to consider. Lastly, let's not forget about competition. The banking sector is highly competitive, and banks that fail to keep up with industry trends or technological advancements may find their market share shrinking. But dear listeners, don't let these risks discourage you. With risk comes reward, and investing in bank stocks can indeed be rewarding. One of the significant rewards is dividends. Many banks have a history of regularly paying dividends, providing a steady income stream for investors. Then there's capital appreciation. If the bank performs well, its stock price can increase over time, resulting in capital gains for investors. Moreover, investing in banks can provide portfolio diversification. Banks usually perform well when the economy is strong and other sectors are struggling. This counter-cyclical performance can help balance out your portfolio. Remember, understanding these risks and rewards doesn't mean you can predict the future. But it does allow you to make informed decisions, weigh your options, and decide whether bank stocks align with your investment goals and risk tolerance. Understanding the risks and rewards of bank stocks is crucial to making informed investment decisions. Now that we've explored the world of bank investments, it's time to summarize our key takeaways. Investing in banks can present a rewarding opportunity, but it also requires a deep understanding and calculated approach. Firstly, understanding bank stocks is essential. Bank stocks are shares of ownership in a bank and are a common type of investment. They can provide a source of regular income through dividends and potential for capital appreciation. However, just like any other stocks, their prices can also fluctuate, which means there's a risk that you could lose some or all of your investment. Secondly, the process of investing in banks is not something you should rush into. It starts with thorough research to identify potential bank stocks. This involves analyzing a bank's financial health, its profitability, and the strength of its management team. Once you've identified potential bank stocks, the next step is to decide how much money you're willing to invest. You should only invest what you can afford to lose. Thirdly, it's important to understand the potential risks and rewards of bank investments. On the reward side, bank stocks can provide regular income through dividends and potential capital appreciation. However, they also come with risks. These include credit risk, interest rate risk, and market risk. Credit risk is the risk that borrowers will default on their loans. Interest rate risk is the risk that changes in interest rates will affect a bank's profits, and market risk is the risk that the overall market conditions will impact the price of bank stocks. Finally, remember that investing in banks, like any other investment, requires patience and a long-term perspective. It's not about making quick money, but about building wealth over time. With these key points in mind, you're now equipped to embark on your journey of investing in banks. Remember, informed decisions are smart decisions.